Chapter 15 focuses on the stockholders' equity section and the corporate form of business organization. Stockholders' equity represents the amount that was contributed by the shareholders and the portion that was earned and retained by the enterprise. There is a definite distinction between liabilities and stockholders' equity that must be understood. This understanding is necessary in order to effectively grasp the accounting treatment for equity issues. This chapter addresses the accounting issues related to capital that is contributed by owners of a business organization and the means by which profits are distributed through dividends. Through the course of this chapter, you're going to be looking at the corporate form, issuance of shares of stock, describing the accounting and reporting for reacquisition of shares, understanding the accounting and reporting issues related to dividends, and indicating how to present and analyze stockholders' equity. Some of this should absolutely be review material. We'll be building on what you learned in prior classes, whether it is Introduction to Business or your accounting principles classes. But remember, there's a distinct difference between a liability and an equity. Liability is an obligation to pay. Equity represents a claim on the residual assets. So let's start with the three primary forms of business organization. There are three basic forms of business, and they are the proprietorship or the sole proprietorship. This is probably the easiest one to start because it only takes you going out and doing business for yourself. There's a partnership in which there should be some legal documentation formalizing that partnership. And then there's the corporation. And you should be pretty familiar with what a corporation is now. We talk about corporations in accounting because they are the most complex form. Corporations are formed at the state level. This is done by state charter and are influenced by the state's corporate law. They have to use capital stock or a share system. And there's a development of a variety of ownership interests within them. Each state has its own Business Corporation Act, and all of these acts are very complex, and they vary from state to state in their provisions and definitions. A capital stock system is a representation of share ownership. What that provides is ownership rights to those who own shares to share proportionally in the profits and losses, to share proportionally in management, to share proportionately in corporate assets upon liquidation, and to share proportionately in any new issues of stock of the same class. That is the preemptive right. So let's start by talking about state corporate law. When you're filing for your corporate charter or your articles of incorporation, what you are doing is you are saying to the state in which you choose to incorporate that you want to do business. And you want to do it in the corporate form. Assuming that all the requirements are properly fulfilled, the corporation charter is issued, and the corporation is recognized as a legal entity of itself, subject to the state law. The laws of the state of incorporation that govern owners' equity transactions are typically going to be found in that state's Corporation Act. Some advantages to incorporating in a state whose laws favor the corporate form of business organization. Some states are easier. Some states act acts are more business friendly. A state that does that primarily is Delaware. There are thousands and thousands and thousands of corporations that are incorporated in the state of Delaware. The accounting for your stockholders' equity will follow the provisions of that state's Business Incorporation Act. However, by and large, there are some generalities, of course, as well, and there are some requirements of GAAP. I'm going to give you just a minute to get back to your book and go ahead and read on the what do the numbers mean. This is on pages 776, 777. So this little blip kind of shows you some of the reasons, not all, but some of the reasons why Delaware is a preferred state of incorporation. Now we're going to move forward to kind of talk a little bit about the capital stock or the share system. In the absence of any restrictive provisions, each share carries these specific rights: to share proportionally in profits and losses, to share proportionally in management, to share proportionally in assets upon liquidation, and to share proportionally in any new issues of stock of the same class. This is called the preemptive right. The share system creates an ability that allows for the transferability of ownership interests relatively easily. You can purchase a share of stock on a stock exchange or sell it with little to no hassles at all. There are a variety of types of ownership interests. So there are different types of stock. All corporations will have common stock. Common stock represents the residual corporate interest that bears the ultimate risk of loss and receives the benefits of success. There are no guarantees to the dividends for common stock, and there's no guarantee that there will be assets upon dissolution. They bear a high level of risk. Another class of stock is preferred stock. Preferred stock says that in return for some certain preferences to earnings, preferred stockholders sacrifice their rights to a voice in management or their right to a share in the profits above a stated rate. They exchange some of the benefits of corporate ownership, some of those rights, for a little bit more stability, for a little bit more of a guarantee. The basic ownership interest being common stock is the type that all corporations will have. If there is only one type of stock, so for example, when the company went into incorporating. They file their articles of incorporation. In the articles of incorporation, they have to, in the state charter, they have to go through a lot of details. How much stock they want to issue, what types of stock they want to have, so on and so forth. If they did not state anything, so for example, they just incorporated with 8,000 shares, that is common stock. If there's no other type of stock there, if it is not defined, it is common. So amongst stockholders' equity, and we're looking at the whole of the stockholders' equity. Remember, assets equals liabilities plus stockholders' equity. When you rearrange that equation, assets minus liabilities equal equity. So what is comprised there? There are several different accounts that are comprised in stockholders' equity. It is the capital stock itself. So here we see common stock and the preferred stock accounts. There is additional paid-in capital, and that is what is paid in excess of par, which we'll get to talking about that here in a little bit. But additional paid-in capital. But there is also retained earnings, or the earnings that have been held by the company and not distributed to the stockholder. Contributed capital is deemed to be the actual capital stocks, so common stock or preferred stock, and the additional paid-in capital. Anything outside of that is a different type of capital. The primary sources of equity are contributed capital and retained earnings. We'll talk more in depth about treasury stock later. Just know that it exists, and it is actually a reduction to the total value of stockholders' equity. So you have filed a state charter, and you need to issue your stock. There are some terms that you should be familiar with that deal with the issuance of stock. One is shares. The amount of shares that you can offer is defined in your state charter. Those are called shares authorized. Then you would have your shares offered for sale. You don't have to offer for sale all of your authorized shares right out of the gate. Most companies do not do that. And then once the shares are issued, so that means they have actually been purchased, they're out there. There are some counting issues that will have to come into play. Is it par value stock? Is it no par stock? Is it stock issued in combinations with other securities? Is it stock issued in non-cash transactions? What are the costs of issuing stock? With par value stock, the par value is credited to the respective capital stock account. So what type of stock is it? Is it preferred or is it common? No par stock is a type of stock that does not have in the charter some type of par value defining it. Par value for your stocks is defined in your state charter. It is there from the beginning and goes till the end. Sometimes you'll have stock that is attached to another type of a security, making this like a combination purchase. Stock could be issued in a non-cash transaction, meaning that perhaps you issue X amount of shares of stock to the lawyer for defense on case A. And then there are some general costs that are associated with the actual issuance of stock that a company must bear. Let's talk about par value stock. So par value, as I said, is defined and provides a measure in the corporate charter. Low par values help companies avoid potential contingent liabilities depending upon the state in which they are incorporated. There may be a legal capital issue at play. Corporations will maintain accounts for each type of stock they have, preferred or common stock. And they'll also have paid in capital in excess of par accounts. This is the additional paid in capital accounts that will recognize the amount that is received in excess of the stated par value. Par value, even during charter, has no relationship at all to fair market value. It provides a measure. That is its purpose. It also stands for potential legal capital issues depending upon the state in which you are incorporated. So let's look at Blue Diamond Corporation. They issued 300 shares of $10 par value common stock for $4,500. They want us to prepare the journal entry to record the issuance of the shares. The first element that we are absolutely aware of is that we received or are increasing our cash by $4,500. We have a measure per share of stock. That is $10 par value common stock. So $10 times 300 shares means that we have common stock at par value increasing $3,000. However, we received $4,500. That additional $1,500 is then credited to the paid in capital in excess of par value. Given this information in front of you, I want you to take a moment, using basic critical thinking skills, calculate how much per share at market value these shares were issued at. Knowing you received $4,500, you divide $4,500 by the 300 shares that it's representing. We received $15 per share. $5 per share in excess of par. So now we're going to discuss no par stock. No par stock means that in the charter, and only in some states is this allowed, there is not a par value defined. There are two basic reasons for no par stock. It can avoid a contingent liability depending upon the state related to legal capital. It can also avoid contingent liabilities if for some reason the corporation issues the stock at what would have been a discount from par value. And then, because there really is a lot of confusion about par value versus fair market value, because remember, there is no actual relationship of par value and fair market value. It reduces that confusion to nothing. However, there have been some states that have levied high taxes on these issues. And in some states, there may be considerable legal capital as a result of no par stock. Regardless of whether there is par or no par stock, we still have to recognize this stock at issuance. So thinking about no par stock, when it's issued, we need to recognize it in the accounts. We're going to use Video Electronics Corporation, who has authorized common stock at 10,000 shares, and they have no par value. This means they can sell a total of 10,000 shares. Now, they've decided to issue or sell 500 of the shares for $10 per share. This means that they're going to receive how much in cash? Give you just a quick second to calculate that. They receive cash of $5,000. When no par stock is issued, the capital stock account is credited for an amount equal to the value of the consideration that is received. So in this case, common stock is credited $5,000. However, there are some states that absolutely require that there be a stated value assigned to no par stock. If there is a stated value, then it is treated much like par value stock, with the exception that the paid in capital in excess account is not paid in capital in excess of par. It is paid in capital in excess of stated value. So here we have a company that issued 1,000 shares of stock that had a $5 stated value. They issued these at $15 per share for cash. How much cash did they receive? They received $15,000, 1,000 shares at $15 per share. They credit to their common stock account $5,000 because of the $5 stated value for each of the 1,000 shares, and then credit the remaining $10,000 to the paid in capital in excess of the stated value. So although you may have no par stock, when a stated value is at play, the entry is pretty much the same as par value.